the end of the day, Chris, as long as you're buying in a good area, you're buying a good quality bit of real estate, you're gonna make your money on it if you hold it for the long term.
All right, hello, it's Chris Hynes from Wealthi, and welcome back to another episode of Wealthi Expat. This week I've got the mighty George Burgess on the show with me. George, it's great to have you here. How are you going?
Yeah, not bad, Chris. All good. Cannot complain. How's things?
Exactly. Yeah, things are good. I guess making the most of the English summer at the moment, the British summer, and the limited weeks we have, as I'm sure you're aware. But yeah, taking advantage of that. I need to get a trip organised, I think, in the coming weeks and have a little holiday somewhere. Have you got anything planned over the next few weeks to get away?
I was originally, we were supposed to go into the States for about 3 months, but due to these vaccine laws and the constant changes, we're just putting it off, man. My family are in Portugal at the moment. We were supposed to go to Portugal as well, but even that's been such a headache. With work as well, it's just been a little bit too much extra stress.
Right.
So we're leaving the travel for a bit.
Yeah. Have you had your vaccine yet?
No, I've not had it yet.
I need to go get mine as well. I keep getting the pressure put on from the other half. She's pushing me to go get it. But yeah, we'll address that in time. There's plenty of them out there at the moment. It's just getting the time to go walk into one of the clinics, I think, at the moment. But it is what it is. So it's great to have you here. I think today we spoke briefly in the past, but we'll touch on it in more detail today. But talking around some topics about the importance of diversification within real estate. I think it's a big topic. It's something that's quite important, and I guess the importance around not putting all your eggs in one basket, in a sense, in simple terms. So it's great to have you on the show and dig into a few more of these topics and understand a bit more about what you do for work as well, the processes you go through, the trends you're seeing in some of these international markets with a lot of work in the States at the moment, and digging into a few of those topics. I guess to start off with a bit of background on George, I met George about what would have been 2.5 years ago now, when we were doing some work together in the past, and we were in different teams, but I showed a lot of interest towards what George was doing at the time around development funding and a new department that he was setting up within the company that we were a part of. And that's I took a big interest in it, a big liking towards it, and tried to work underneath George's wing. But yeah, now you've moved on and you've started your own business in the same field of work. I guess, do you want to give us a bit of a background on the business itself and let the listeners know what you do exactly?
Yeah, sure. So I mean, to keep it really simple, we're essentially a real estate developer now. So what we're doing is we obviously predominantly we're always raising capital, right, for real estate projects. So we were responsible for bringing in the extra layers of equity and the debt components to finish the capital stack for the developers. And then we said, well, why don't we actually start becoming the developer and partnering with the developers and still doing the same sort of role, but then sort of tying the fee structures into the deal itself and using that as equity as well. Hence making our sort of longer term vision more accessible. That's kind of the model we're adapted now. So essentially what we're doing now is we're developing our own, sponsoring our own real estate projects. And we're very particular now. So whereas obviously you would have seen before, we were doing projects pretty much all over the world, right? We were doing stuff in Australia, the USA, Europe, Middle East. So we do now have a very keen focus on just USA-based projects and multifamily as well, which is essentially a USA term for residential, apartment buildings.
Okay. Yeah. Okay. It's interesting. Now, is there and sort of price points you're working with at the moment with some of these funding deals? Is there? I remember in the past we were steering clear of stuff that was under 100 mil at the time. But are you working across a variety of fields now, or are you still focusing on the higher end of the market, so to speak?
Yeah, it's interesting. We're being a bit more. I'd say we're being a bit more sophisticated now with the investments that we're looking at and how we're structuring them. So before, we're looking at minimum project sizes of sort of $100 to $150 million, going up into the $1 billion range, which is still the playing field that we operate in. But the way we're doing this now is we're doing more sort of portfolio deals where we're bringing in several projects which might have a price point. We try to look at price points from 15 to 100 million and sort of bundle a few of these projects together. And we just like these kind of deal sizes. We like the returns. We can really do a great execution on these deals. We're very comfortable with these sort of size deals. And essentially then from a fundraising point of view, it's just a case of, raising for the whole portfolio and going down that, line of credit option with the institutional guys and the private equity banks.
Sure. Okay. And I guess as well around the US component now, which you're heavily focused on, what drove you to focus majority of your time and effort into that market, so to say?
Yeah, it's a great question. I mean, obviously, a lot of my clients ask me this, right? You're in the UK. What are you doing? Why are you so
Yeah.
focused on the US? What got you into this? And to be honest, I just fell into it. My background as a musician, right, since the age of 6. So I'm not someone who's been through the whole college, university, corporate system, really. Obviously, we met in a corporate situation, which was my first experience. And I think things just fall into place, right? A little bit of, fate, or whatever you want to call it, law of attraction. But I wanted to get into this field more and more. And then I obviously then was working with a very large family office in London, which was a multifamily office made up of families from the USA and European families. So they had a big focus on USA projects. And, obviously with the world that we live in, and from my media experience in the past, I knew that I could reach people anywhere around the world. So I said, well, let's just, pick these different areas. And I sort of, leveraged the infrastructure that we were in to get messages out to different teams in different parts of the world so that we could, essentially find these projects for them. And I just so happened, Chris, to be honest, it was just meeting the clients over time. I was doing a lot of stuff in Texas. So a lot of my clients were just based in Texas. And I was just naturally learning more and more about the market. And as I was doing this, I thought, wow, this is actually seriously incredible. I prefer the market than the UK. I prefer the relationships we have with the USA clients and the way that we sort of engage with each other and do business. So I sort of stuck with it. And I just see, again, from a European point of view, the advantages that we're seeing from, tax incentives, etc., and just sort of more flexibility on the investments by operating on the sort of foreigner entities. Sure. We like the market, so we've stuck around, and we do pretty much heavily focus on that sort of Midwest, Texas, Oklahoma, Memphis, and sort of surrounding states.
Interesting. Okay, I guess that can kind of lead us on to the next question about talking about the fundamentals of what makes a good deal in essence, and talking about the price points, the sort of returns and investments, I guess the process to a good deal in a sense on your end. And yeah, we can talk about a few of those topics. So I guess at the moment, when we're talking about what makes a good deal, what sort of returns and investments are you seeing in some of these locations in the States? And I guess, I don't know if we can talk about it now, but in comparison, I guess, to the UK as well, weighing up the differences there and what you're seeing across the US real estate market and then the UK, I guess, drawing the comparisons in a sense. But yeah, what sort of returns? Let's talk about the returns on investments at the moment that you're working on in a sense.
Sure. So I think I guess the whole sort of main question there is, what makes a good deal? What we're looking for, right, in our deals. And to be honest with you, the returns are not something that we're extremely bullish and focused on. At the end of the day, it all comes down to the execution of a deal. And that involves people physically doing their jobs and putting their blood, sweat, and tears into the operational side. So realizing that and realizing that it's really down to the operations, which is going to control our risk. We're mainly focused on the people and the companies themselves rather than returns. And it just so happens to be when you do that, when you start working with people that really know what they're doing and they know how to find these deals, then actually it's not down to us to find these deals. That's not our expertise. I don't know the Tulsa market and the brokers in Tulsa and all the guys that, have the secret phone books and the little
family relationships. And
I'm not in that scene, right? But my partners are that get these access to these deals, etc. So for me, it's always about finding the right people that, looking into that company background of the people themselves. What have they done before this company? What's the company done so far? What is their real vision and ethos? And by doing that, you really then get to learn more of the story around a project, and that is really, for me, what makes the deal good. Having a story behind a project, then go and explain it to an investor, or if me and you are talking now to tell you about a deal, you've heard it a billion times, right? About this is the returns, this is the IRRs, this is the time of project, how many units, this is the amazing area, this is coming in, blah, blah, blah. When you've got a story around an asset of the reason why it's for sale at the price point it is, and the reason why it needs to be done fast, and you learn, what's been happening on in the history of that project and the asset, it can create a lot more of, interest around the asset before you even get into those returns and numbers. And that's really, again, what's important, and having the right teams to execute it. But just to answer your question on the kind of returns that we do see, we're looking at, we have different strategies. So it really does depend on what strategy we're going down. But if we look at the sort of topic of this conversation, which is about diversification, the way that we diverse is we do only do multifamily, but the way that we diverse is we're doing rehab projects, we're doing affordable housing projects, we're doing ground up new construction projects. And, the returns are going to look different for each kind of projects. These rehab projects, we're buying units right now that you could not physically build for cheaper brand new today. It would cost you a fortune because of construction costs, right?
Of course.
So,
Sure.
We're getting these really amazing undervalued assets coming in doing the soft rehab work. And, we're seeing anywhere between 2 to 3x on your multiple of equity in 12 months, once we've come in, and 12 to 18 months, I would say, to be conservative on the 18-month mark there, let's say. And, we're seeing these sort of 2x, 3x returns. And that's because of the simple metro market and of what's happening right now due to the construction prices and the price of property going up so much. And, it's caused a lot of distress in these certain areas. And again, comes back to the deal side. These people and these teams that are so experienced in these, suburban areas are really not where a lot of the big institutions and investors are looking. So there's this kind of pocket that you find access to of these deals, which is, really great, fantastic deals where just some people aren't maybe looking as much. So, again, to try and summarize that good deal,
finding the opportunity.
Yeah, it's the opportunity, it's the right team. And I think, from there and the story, like I was saying, if you've got them three components, I think, you shouldn't have a problem being able to interest people to come and put money into that deal.
Into the deal. I think that's interesting. And with a lot of the projects you're working at the moment, if it's something that you're able to disclose at the moment, but what sort of price points are some of these developments that you're acquiring around, and then a bit of an idea maybe as to the type of development. I guess you just mentioned then about the rehab and the new builds and existing properties as well, and diversifying across the different asset classes. But are you seeing a focus on, say, residential, large residential master plan projects, be 50 houses, 60 houses in a little master planned community, or is it more of a focus towards apartment living and developing new not high rises, but just small apartment buildings in these smaller communities that are still, have good connectivity, have good opportunity, employment growth, infrastructure investment as well. All of these sort of things that we've been instilled for years now. Yeah. Investment properties, but I guess the sort of asset class, in a sense. Have you what's really on the radar at the moment?
Yeah, sure. I mean, when it comes to asset, like I say, asset type class, but multifamily, we're going to look at anything multifamily, whether it's class A, B, or C, rehab projects, ground up. We're going to look at anything. Price points between 15 million, 100 million per asset. We have institutional partners and investment banks and funders behind us, which will, they can do a $8 billion facility for someone. Yeah. So, we can do these huge master plan projects and all the rest of it. It's not our focus. However, the way I've kind of tied in my institutional background, right, the hundreds of $1 million deal kind of experience to what we're doing now is really looking at the longer term goals within the client's actual or the client's goals, for example. So a lot of time we speak to developers, they've got a project they want raising capital for, and then what they do is they raise capital and it happens any way they can, right? It's usually quite messy, last minute, things are extended. It's always quite chaotic. And then usually what happens is the developer will tell us that they've had fallouts then with the guys that did the deal and it wasn't so great doing the deal with them. So they don't want to use them for the next one. So they're back at square one and they're re-raising again and they're trying out, speaking to people like me, right, to try and get a hand with it. So when it comes down to, when we're engaging with our clients and we're understanding, it comes down to what do you want, right? What is the goal here? And, we don't tend now to work with lots of, we speak to lots of developers and projects a week, but we work with so far few and in between. It's very select who we work with, and we want to take that longer term approach. So if we look at it and we say, what is actually, what are we capable of doing within this team? What are you guys capable of actually deploying over let's say the next 2 to 5 years? Let's look at this like a long-term plan. So we can do these initial deals that we have in the pipeline. We can look at getting these funded, but then let's really look at building an actual pipeline that we can go and take to the bigger players and get better terms on our debt, more flexible terms. And really, Chris, to be honest with you, it's all this comes down to is speed, and everything in our game is really about speed. And these good deals are so good if you can close them in time, because they're very good, which means they have a lot of people potentially looking at them, wanting to pay a bit higher prices for them.
The competition, I guess, in a sense, and the fueling the battle. It's almost like going to a bidding war, and if someone wants that asset, if they can see the value that it's going to create over the long term, not just the short term, but over the long term, then I guess it creates that competitive marketplace, which in turn makes it a more difficult process for you unless your client's ready to push the trigger straight away.
And that's it. And if you've got a sort of Bazooka sat behind you, for example, right? Like a big fund of $300 million facility sat behind you, and you're able to literally walk in there to a seller and say, listen, we're backed by this super credible partner. Here's our balance sheet or proof of funds, whatever you want to see. Yeah. We can do this in 30 days. You're going to do a number of things by doing that. You're going to be known to other sellers in the area. Sellers that have the building that have sold to you are going to want to sell other assets to you. You're going to impress your brokers because you're moving fast on their deals. You're good to operate with. And again, what does that come down to? Execution and the operators. So, it's all good having a great deal, but then if people are procrastinating and taking a while to make decisions and not coming back to people on time, it really is the small things, right? It's the simple little operations, which really comes down to that individual grit of the person that is responsible for that job. And again, that's why we look at people so much more than corporations and these big brands. I want to know that, if things are going wrong, there's men on the ground and there's women on the ground, and they are quite literally going out their way to solve the problems that arise, rather than being a big institution or organization where you can look to pass blame, maybe leave things a little bit longer than you normally should.
Sure. So, no, it's a good point. I remember even when we were trying to do some things together, and the importance of having that good team on their end, on the client's end, was, if that wasn't happening at the first meeting, then it was almost a no-go. But it's having the people on the ground and just making sure the process is as efficient as possible, really, given the circumstances. So that's interesting. And I guess touching back on that house versus apartment sort of stuff, what sort of, are you able to give an example of what sort of development you might be funding at the moment, be a housing community or be an apartment complex, or even a commercial or industrial sort of project?
Yeah, sure. So one of the projects that we are just closing on at the moment, it's a value add project. So it's a rehab value add project. And we've got a real focus on, with one of my partners, it's a huge focus on giving back to these communities and really creating a genuinely better place for people to live, to improve their lives, really change their lives, grow these communities, and at the same time, build investor wealth. And the thing is, it's really, really interesting, because by having this real natural, I guess for these guys, natural response to the market and wanting to do something from an angle which is more about focused on the individual tenants rather than the profits and the returns, and like the institutions and the corporations will focus on. These guys are focusing really on, because they've been through it. They've been through the affordable housing routes. They've been around it all their lives. They've been in the military. These are people that have always been working in non-profits, example. So when you do that, Chris, when you look after the end tenant, they stay longer, they're happier, your occupancies are higher. What does that mean? Higher returns.
Of course. A
So,
win-win for all.
yeah, so it's, we're focusing a lot on these value add projects. So what we're doing right now is a value add project where it's a community that's been owned by several wealthy individuals, and they're not operators of a affordable housing complex, right? So they don't really tend to do this in a day-to-day. They're very wealthy and are passive investors. So they bought an asset many years ago for sort of $20,000-$30,000 a door. They're getting a really good cash flow on that, right? And even though it's a small cash flow coming in, when you total that up on thousands of units, it's really nice yield, right? So they basically bought a load of these complexes. They've left them for a long time. It's getting more and more distressed. They've not managed it. They've not looked after the health of these people from a physical and mental aspect, which you have to do. And as a result of that, they've just drove their occupancy rate right down, and they've really just got an asset here which is in a bad way. And they don't have the expertise to come in and fix things up and start demanding more rent and putting more ecosystems in. So, we've got this deal off these guys, and we know we can come in, add a lot of value. The occupancy is at around 56% currently, and it's breaking even. So we know that this asset, even if we just buy it, we're going to be breaking even where it is right now. But by the time we do, the value add and the works on it, whatnot, we're going to we're putting the asset value to near sort of early 20s in the millions there. So we're sort of picking this up for 15, and we're going to be spending a couple of million on it. And we've got a value there of around 21 to 22 million. But then what we do, Chris, we refinance that out, pay our investors back a large lump sum of their initial money, and then we hold on to that to an asset management company as well. So, we can then hold on to these assets long term and keep our investments in it. So that's an idea of one of the projects we're on. And again, that's a rinse and repeat process. So this kind of deal now, once we've got this one done, and we've already got the second one lined up, the third and fourth are in talks at the moment, and it's just a case of building up this pipeline so that we can then go to our institutional partners and get that larger funding in to really scale the business.
Grow it, definitely. I guess something that's also quite trending at the moment around the ESG development, sustainable and economic sustainable governance development. So I think that's an important factor. And if you've seen, I think the states are quite bullish on it at the moment, but is there a shift in which it's moving towards a more sustainable way of development?
Yeah.
Have you seen the change?
Yes, it's a huge. I mean, it's a really good topic, ESG. I was at the event in Mayfair last week at the family office event. Well, I was working at the event, and we were just listening to companies speak about ESG, and they are specifically ESG companies trying to really help on some of the problems that we see and reducing, emissions, etc. And in the real estate sector, I've sort of said it for years. If a lot of small companies and owners and individual people can start applying this, then we can all literally make a difference. We can if we all do this. And it takes smaller companies like myself that are starting in this industry where we're growing and scaling. If we're adapting this and pushing this from day one, even 5 years from now, maybe we can have made a little difference in our own little way, just for our own clients. And maybe that can rub off, and if everyone does that right. So ESG, ESG is essentially, just doing the right thing. Whenever we look at it, there's all different sorts of terminologies for ESG and, sustainability, or is it socially, whatever these letters come to different people as. But we all know we need to be doing this. We all know we need to be taking this more seriously. We're seeing it a lot. We're seeing it a lot more now. Every project I'm seeing, there's lots of components around ESG. And what's been really interesting is in the family office space, I work with some partners of mine who deal with family offices, and they help with all of the capital raising for startup companies around ESG. So they're only focused on ESG companies. And what they're doing now is moving into sort of more, they're seeing more real estate companies coming up in the market where they're offering, sort of solar solutions and different materials, construction materials as alternatives, which are more sustainable, better for the environment, cheaper.
Of course.
So, ESG is something which I think has always kind of been looked at as it's going to reduce profits, and it's not going to be a financially feasible deal if we start having to do X, Y, and Z. But I think
that's true.
It's
almost like the tables have turned. in a sense, and from something that was considered more expensive, a harder way of doing it, it's now a more efficient way, a more affordable way, and a more environmentally friendly way of doing it. I think it's our mindset in a way. I think our mindset's changed towards the way in which we look at it now. And in Australia, for example, they're making full timber framed buildings and massive high rises just made of timber. So I'm sure it's happening. It's happening in the UK, it's happening in the States and around the world. But it's, so that's something like that was probably never even considered 10, 15 years ago.
Yeah, well, it's kind of becoming, it's becoming more in your face in general, but it's also becoming more implemented in the back ends as well. So institutions being cracked down on this. You can't be deploying billions of dollars of capital into projects, right, which are very harmful. So once the bigger players start adapting this more and more as well, and it's just mushrooming out. I think it's a positive thing. I think we are going the right way, and I think we just need to keep adapting it more. But a lot of the guys now, if we're coming down with projects, I wouldn't do anything that's not got a company which is genuinely as well trying to reach that ESG goal. Because that's the issue with ESG. A lot of people and developers of companies are taking this on them to say we're ESG, but they don't actually care about being ESG. You can see it in the mannerisms of they speak. They're doing it to tick a box. And I don't think you're going to change that, to be honest, Chris. I don't think you'll ever change that. So I think that's down to, again, institutions cracking down to and regulatory systems to say, you do need to be checking these boxes. You do need to have X, Y, and Z in place. Who controls that and how long that'll take to implement, exactly. I don't know. But to summarize it, we're seeing lots of positive movement in that area. People are taking it more seriously. We're working with Tesla and companies like this to get their car spaces in, for electric charging points, which, by the way, you put a brand like Tesla on your project, gets more interest. So, and again, it's using these companies to everyone's benefit. And I think, that's really the way that you can sort of make a win-win situation from it all.
Definitely. I could see in the States as well, the introduction in the future, maybe a couple more years, but the introduction of a government grant in a sense on the basis that your development is not just ESG classified, but
we already see it.
Yeah. So meets the criteria. Yeah.
We did a project in Germany as well. And that project was, again, they were allowed to get grants from the banks and the government because they were meeting, certain measurements of energy efficient buildings, charging points, X, Y, and Z. So it's already happening. Again, that's causing that incentive. It's actually reducing debt coupons, things like this. Impact investors are now coming more and more apparent into these projects. So we're seeing it. We're seeing it definitely moving that way.
It's good. It's a good driver, hopefully. And a lot more economies, a lot more countries start to follow in suit. I think Germany's a good one. Germany's always, I guess they always seem one step ahead of everyone in terms of environmentally sustainable just way of living, in a sense. They're just a very green way of living. So that's good to know. Next question that I'd like to ask you, or just any, I guess, suggestions or tips that you may have, but any recommendations that you would like to give in terms of investment, some investment tips, or if you were going to start on the ladder today and buy a property of something within your means, for example, what would you be looking at? What sort of tips or process would you be looking at to get you onto the ladder?
Yeah. My honest answer to that question, I get it a lot, and the honest answer is, my friends always say to me, right, I've got this money, what should I do with it? And I always just say, first of all, just think about what you actually want, right? As corny and deep as it sounds, just really take a minute and think, how do you want to live your life? What is this money being invested for? Is this for security? Is it for 35 years down the line? Is it to just provide wealth for my kids or is it just to look after? Or do I want to make this money work as fast as I can because I want to quit my job and get enough money to do so and start being more aggressive? So when you ask yourself that question, you kind of get your risk appetite adjusted for you naturally, right? Because if you're someone who really wants to go aggressively for 12 months and try and double equity and 3x equity, things like this, rather than doing a double over 10 years, which might be like buying an apartment and letting it appreciate over time in a good area and getting a little yield as well. So I think always, first of all, ask yourself that question of what is the reasoning why I want to invest this money? And when you understand that, you can sort of understand your risk appetites, and then that risk appetite will allow you to see what kind of percentages you're going to get, right?
Yeah.
So we know
That's
if we
true.
go and buy a triple net deal in the States, which we also do. So this will be a property maybe that a university is a tenant of. So it's an asset. The university are renting it out. So they're renting this building. It's just for the science department, art department, whatever it may be. And they're on a 30-year lease, and they've agreed every so often that we can put the rent up by a certain percent, and it's a really strong lease contract.
Yeah.
And we're pretty confident that university isn't going to go, bankrupt or not be able to pay its rent, right? So
Of course.
something like that, we're going to expect it's so risk-free, so safe. We're not going to expect high returns, right? So anywhere between, 4 to 8%, we're probably going to be pretty happy with it. We call it sort of mailbox money, right? You simply, it's all turnkey.
Yeah.
The asset is coming in.
Money's
And
coming.
then you might think, well, actually, I really want to make my money work for me faster right now because the timing's an issue. So I want to go and do this rehab project with Burgess Group, because I know that in 18 months, I can actually 3x my equity on one of their deals, right? I know that sounds like a crazy number, by the way. I'm not being deluded either. We have got a deal at the moment which is getting us 3x equity, and that's being conservative. We will still drop when we put that out to the investors, though. We'll put that down as a 1.8 to 2.2 equity return, and we'll put literally we had numbers, man, like crazy. We'll put operating expenses at 50%, not 35, even put higher sometimes.
Yeah,
just because we like to stretch the deal out as much as we can, and we live by that saying that under promise and over deliver. So if you've got that question and you're wanting to invest in something a bit faster, you might want to go into the rehab project. So it's a rehab project. We're going in there, taking a discounted asset because of the story behind the asset. We're getting a discount. We're doing the soft works because we've got the team that can do that work and execute it. And then we're going to refinance that out through, whatever, pay off investors, and then hold on to the asset because we have an asset management team. So that's a good investment. And again, for me, when I think of it personally, and I guess this might help people if they're unsure of what they're doing, but for me personally, look at us, right? We're young. I'm 28 next week. Literally next week I'm 28. So the way I'm looking at this, and we get really good tax advantages for doing this as well, but if you're holding real estate, 10 years plus in the US, we're getting good tax benefits and all the rest of it. So everything to me is a long-term game anyway. So the way I see this is also I want to be doing is real estate. I'm having a diversified real estate portfolio. I'm creating that as we speak. So for me, it's all about just reinvesting back into more real estate assets. So even if it's like, your clients where they're invested into, 1 or 2 apartments for their long-term portfolio, and they may be getting some rental yield from that and some cash coming in. Again, for me, that's a case of, again, maybe it's not a tip, it's just a personal preference, but that yield, I don't look at that as cash flow to myself or a business or anything. It's simply just building up like a savings or a storage pot. And
reinvesting for the next.
Yeah, because that then equates that IRR return, right? So it's constantly reinvesting that cash in and just sort of, one thing I used to dislike a lot is when we used to get told a lot, and you hear it a lot in a lot of investment companies, remove the emotion away from the investment and look at, stats and numbers and all the rest of it. I don't think you can do that when it's your money involved. I think certain people can, of course, but I don't think to everyone that's something you can do. I think there's always going to be an emotional attachment there. So I think you've always got to listen to your gut. You've always got to listen to your gut. And this is why, especially when you're an investor that's looking at a company like yours as well, right? They're looking at branding the company, the people behind it, and you can get familiar with it. You guys are so transparent. You're doing these podcasts, they can get to learn about your team and how you are as a company, and just get a general feel for the way that you execute and operate.
Yeah,
right.
Definitely.
So I think, for me, always looking at the company that you're investing with down to as much detail as you can. A lot of these investment companies and products that you invest into, you don't actually know what them agreements are in the back end. Okay, so as an investor to a company, there's your agreement. But that company then has agreements in the back end with all of their partners, developers, real estate, whatever it may be, right? You don't actually get to see that sometimes. So, again, the way that we do it is direct investment. You're part of an LLC, you're part of a legal structure, it's open, you come into the room, we all invest in a deal together, it's very exclusive, off market, blah, 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 and you're part of that. So it's something that's more tangible to people. And again, Yeah. But again, so for me, again, that causes that emotional attachment though. You're actually a part of
Mm,
something where you
yeah,
are in a company structure and you're doing something for a community. But then again, Chris, I also want something long term going on in the background always. So again, I'm looking at holding onto apartment units, right? We have a few properties in the family that we haven't just rent out to tenants. And I think as long as, at the end of the day, Chris, as long as you're buying in a good area, you're buying a good quality bit of real estate, you're gonna make your money on it if you hold it for the long
true.
term. And that's what this is all about for us. We don't know what's going to happen a year from now, 10 years from now. We can only make,
Right.
our choices today. And as far as
Yeah,
I'm concerned, real estate is always going to be a good long-term investment. So
exactly.
my tip
Exactly. I
is
guess
stick to real estate.
stick to real estate. Yeah, I think it's important what you're saying as well about I guess you touched on it slightly when you were speaking then, but the diversification still in assets across real estate. And like you were saying, your parents own, apartments, for example, and a couple, I guess there's probably sort of their house that they live in as well. But it's just having that diversified portfolio and not putting all your eggs in one basket. I think when we look at Australia, we try to suggest to some of our clients that they should consider interstate investment. So don't invest all your money into New South Wales and Sydney. Spread it across Queensland and Victoria. And I guess Australia is slightly similar to the States in a sense, with the way that the states are split up and they all run on their own governments and
Sure,
different
sure.
rules and legislations in a sense. So diversifying that over the country and your assets, I think, is an important thing to do. But yeah, I guess you touched on that already. But last question that we want to ask you, and I've given you a bit of prep for this one, but what does a wealthy life mean to you?
Oh, that's a good question. Yeah, it's a great question. I mean, it's interesting for me, the whole money thing and the way I view money, I think, compared to most people in my position and doing the job I do. It doesn't
Yeah,
drive me money, it doesn't drive me to have luxury goods and have the money and all the rest of it. Wealth for me is, I went through a period where I had no money. So, and I mean really no money. So for me, the wealth thing has always been a security feeling, I think, having a subconscious relaxation that you're always okay, right?
yeah,
Just knowing that my mortgages, my rents, my outgoings are always covered without me
yeah,
even batting an eyelid anymore is the
yeah,
most, content feeling for me. And that makes me feel wealthy, I would say. So I'd say I've actually,
definitely.
for me, it's already sort of hitting that point. But the way to protect that as well is only through one way, and that's growth. So that's also my mindset. So that's where the sort of aggression and the drive comes from as well, to keep growing this, because to have this comfort behind me subconsciously that, you know, the wealth is sort of there and I'm okay and I'm safe,
Yeah,
needs to keep growing, because otherwise it will decrease, as you know,
yeah,
right? Nothing
exactly.
stays plateau, right? So it's
If
always
only.
up or down. So my mindset very much around the wealth is just to keep on growing the wealth. If you do that, you're never gonna, and
Exactly.
also
Having that.
rule number one as well, which is never lose money.
If only it was that easy. But yeah, no, it's good. I think it's all like you were saying around that passive income and making sure that at the end of the day you're growing your portfolio, but having that income coming in to continue growing your portfolio, not to go in your pocket in a sense, but to cover everything else that's going on in your life. So
Yeah,
no,
just
that's
just just to touch upon that as well. That's exactly what it is. It's a lot of your clients as well. I believe will probably be in this mindset of creating that passive income, right? To the point where maybe they can even not have to work anymore because the properties are paying them income, and they can keep, every so many years they're growing, they're refinancing, maybe some more money comes in, they keep reinvesting. And you've then literally got, like, as you know, you've got then, if you take that long-term approach, even if you're early on right now, you've only got, a bit of savings, etc. After 10, 15 years, you can be in a position where you literally are completely scot-free, right?
yeah, you turn into a millionaire. You're a property millionaire.
Well,
So
that's another. Actually, one of my partners, they do that. They run syndication models. So maybe I'm not too sure exactly how your infrastructure works, but they essentially syndicate LP
okay,
investors and equity investors' money, go into the projects, and they actually have through their CRM system, they can see, who's actually become a millionaire since they've been investing
all
with
right,
their company. and they get sent the sort of the cool hat, baseball jacket,
Yeah.
sort of welcome to the family kind of feel.
Yeah,
And again,
exactly.
I love
It's
that
good.
kind of feeling, right? So that's where I think emotions can be in it. You can have these
Definitely.
really nice relationships with your investment companies, and I think that's what it feels like with you guys with Wealthi. It feels like that's sort of the approach you guys
Definitely.
are taking on.
I think it's important to remember at the end of the day that these people, we deal with property, we sell property, we buy property, whatever, regularly. And to us, when we hear 500,000 now, we think, okay, just do it. Makes sense. Sign the dotted line. And that's because we see the number side to it, I think, and understand the numbers. If it makes sense, that is, you'd sign that document. But to a lot of these mum and dads and first time investors that are buying some of these investment properties, that's a lot of this, they've saved up for the start of their life to buy this investment property or their first home or whatever it may be, and parting with that 500 grand or the 600 grand, whatever the budget may be, it's an emotional thing. It's if you're tight, that you've put a lot of hard work and sweat and effort into you building these savings and then getting your mortgage approved and buying your first property. So we need to remember at the same time that it is an emotional decision. It's a big decision to a lot of these people, and rightly so. It should be. It's one of the biggest purchases and investments you'll ever make. So it's remaining very what's the word? It's remaining on just on the emotional side of it and touching in on the emotional side in a sense.
Yeah. Well, I think it's at the end of the day, it's human to human interactions. At the end of the day, you're dealing with other humans, like I say, with actual problems, and it's a big deal to them. And it's just being, I think from your guys' point of view, it's just being comfortable for them and there for people. One of the issues that I see a lot, there's been issues where we've even looked at using platforms as such, for capital raising, etc. And you look at the execution side of this on the back end of it with customer support, investor support, and all the rest of it. And it's horrible, actually. It's quite frankly horrible. And, there's no reason why it needs to be like that. If you're invested into good, safe assets,
exactly.
Makes
sense. Well, George, it's been great to have you on the show. Really appreciated chatting to you. Hope you've enjoyed jumping on. Love to get you on again later down the track, maybe when you moved over to the States and get an update from you of what's happening in the States. But I hope everything does go well for you. And it's been great to have a chat, mate. So thank you.
No, likewise, Chris, and thanks for having me on. And I'd love to be back on again, man. Sounds great.
No problem. All right, we'll speak soon. Thank you for everyone that's listened, and I hope you've got some value out of this. Enjoy. Thank you.